All right, so moderate risk investment. As an investor, it's important to know how much risk you're willing to tolerate when investing your money. This is called risk tolerance, okay? If you want a higher rate of return, then you need to accept higher risk. So risk refers to the potential of your losing some or all of the money you invested. Now, a portfolio is all the different investments that an individual organization holds. So to reduce the risk of your investment, you should choose a mixture of investments so that if some do not do well, they can be offset by the ones that are doing well. This is called a diversified portfolio. If you hold a diversified portfolio with a variety of different investments, it's much less likely that all your investments will perform badly at the same time. Moderate risk investments have higher rate of return than a savings account because they are riskier. Now, there's a couple of different types of investments. One's called a mutual fund, and essentially what a mutual fund is just a basket of investments such as stocks, bonds, and other funds owned by a group of investors and managed by a portfolio manager. It allows us to invest in a variety of stocks, but only purchases one fund. Now, if you want, you can watch this video. How do they work? When you buy a mutual fund, you pool your money along with other investors to purchase units or shares of a fund, and a portfolio manager uses the money to buy and sell stocks, bonds, and other investments depending on the objective of the mutual fund. The profits are then returned to shareholders monthly, quarterly, or semi-annually in the form of what's called distributions. Mutual funds allow smaller individual investors to access diversified, professionally managed portfolios at a low price that are normally only available to large investors. Mutual funds can earn dividends if a stock owned by mutual funds pays a dividend, which are paid directly to the shareholders. If you hold a mutual fund in a registered plan, like what's called an RRSP or an RESP, RRSP stands for Registered Retirement, and then RESP stands for Registered Educational Savings Plan, you won't have to pay tax on the money until it's withdrawn from the plan. So there's some advantages and disadvantages. These are not guaranteed or insured by the Canada Deposit Insurance Corporation, even if you buy it through the bank. So there's a possibility you can lose your money. You have no option to customize the holdings of the mutual fund, meaning you are stuck with what the mutual fund manager chooses. And there are, of course, fees. So somebody's managing this, so you have to pay them. Now, ways to make money from mutual funds, there's two types. One's called capital gains, and the other one's called distribution. So capital gains is basically if the mutual fund grows in value, and distributions is when they pay you out quarterly, semi-annually, or annually. Now, there is just a series of categories of common types of mutual funds and where you can buy them, okay? So I'll let you read that. The next type of investment you can have is what's called an exchange traded fund, or what's called ETF. And an ETF is an investment fund that holds a number of investments, such as stocks or bonds owned by a group of investors and managed professionally by a money manager. And again, if you want, you can watch this video. The difference between ETFs and mutual funds is that mutual funds are actively managed. Meaning there's a portfolio manager and a team consists of actively buying and selling securities in the fund to try to get the best return, given the mutual fund's purpose. While an ETF is not actively managed, it follows a pre-existing percentage of certain stocks and bonds. This means that the underlying asset of most ETFs do not change much. The makeup of an S&P 500 ETF, for example, does not change over time. Now, ETFs are traded on the stock exchange, like the New York Stock Exchange or the Toronto Stock Exchange. ETFs typically have lower fees than mutual funds because, well, no one's managing it. It's easier to keep track of the underlying assets in ETFs since they do not change as much as mutual funds. So the percentages of each particular company stays the same. Now, ways to make money from ETFs. Some ETFs pay out money made to investors. These payments are called distributions. For example, you can get interest distributions, you can get dividend distributions, or capital gains. So interest, of course, is sort of like a savings bond. It just, they pay you for holding it. Dividends is if the company makes money, they pay you back. Capital gains is if the ETF increases in value. So unlike many mutual funds, ETFs do not reinvest your cash distributions in units or shares. Here's what happens with your distributions instead. The cash stays in your account until you tell your investment firm how you want to invest it. You may have to pay a sales commission on what you buy. So basically they give you the money, you just hold it into your bank account depending on what you want to do with it. Your investment firm may offer a program to automatically buy more ETFs. So this is like an automatic reinvestment program. You can sign that up for as well. You won't likely have to pay sales commissions because these are automatically, so the system just buys them for you. All right, so there are a number of ETFs. One's called a stock index ETF. So for example, the S&P 500 ETF, the TSX ETF. Commodity ETFs are if you want to invest in like precious metals, energy, for example, or even anyways, there's different categories, okay? Number 3. Here's the one that most people are interested in, stocks. A stock is an actual share of ownership of a company. This means that if you own company stock, you actually own a percentage of the company itself and are entitled to share of the profits and vote in how the company is run. There is a video for you to take a look at. Difference between stocks and bonds. When you buy a stock, you're buying a piece of ownership of a company. A bond, however, is more like a loan. So you're loaning money to a company. The bond is a promise that the company makes to pay you back the amount you lent them plus interest. Hence, if you own a bond, you are only lending the company money. But if you own a stock, you actually own a portion of the company itself. So for example, if a company issued 1,000 shares and you own 100 shares, that does not mean that you can go to the company headquarters and take 1/10 of the furniture. It means that the company was profitable, and let's say they made $100,000 and decided to pay it out to the shareholders, you would get 1/10 of that $100,000, which is $10,000. You want to invest in a company that you think will be profitable with the hope that the company will start paying its profits to its shareholders. So it sounds like a pretty good deal, assuming that the company is profitable. So here it says, ways to make money from stocks. Company profits may be divided among shareholders in the form of dividends, and larger profits can be made through an increase in the value of the stock on the open market. So if the value of the actual stock increases, your wealth also increases. Now, where can you buy stocks? Most people buy them from full investment firms. That includes banks, typically banks, discount brokerages, or portfolio managers. Now, stocks are traded in an organized market called the stock exchange. Some are widely known are the ones that are called the Toronto Stock Exchange, TSX, TSX Venture, New York Stock Exchange, NASDAQ, which is also located in New York, and then the London Stock Exchange. There's a whole bunch. There's the Japanese Stock Exchange. There is ones in China as well. They're all over. Now, it says 4 things you need to place in order to buy a stock. Well, first of all, you have to decide which stock you want to buy. Then you have to decide the number of shares that you want to buy or sell. The next thing is how much you want to pay for it. And there's 2 different types. One's called a market order. Stock is bought or sold at the latest price. So when the stock exchange is open, you can sort of take a look. They vary from second to second to second. So when you purchase it at market order, it's whatever the going price is at the time you hit buy. Limit order is you set a price limit for the highest price you're willing to pay or the lowest price you're willing to sell it at. So you can sell it at something slightly higher than the going rate, and then it'll trigger the sell. Or you can buy at a price that's lower than the current going rate as long as it's traded between the hours of operation. So for the Toronto Stock Exchange and the New York Stock Exchange, it's between 9:30 and I believe it's 2:30 Eastern Standard Time. All right, so limit orders are lower than the current rate if you want to buy and higher than the going rate if you want to sell. And then lastly, how you want to buy. So there's a couple ways. You can use the money from your cash account to buy money or stocks, or you can borrow the money. Now, these are what's called on margin or short selling, and it's very, very risky when you do margin or short selling. And the reason being is, imagine for a moment that you want to buy a stock that you're hoping that will eventually go up in price. So you're paying whatever going rate is. The problem is you have to clear the order by the end of the day. So if the price drops at the time that you bought it, then you have to pay for that current price, even though the price value decreased, and you have to settle at the end of the day. So there's a possibility of losing money. Short selling is the opposite. What you do is you're essentially grabbing someone else's stock. So for example, Tesla, and you're hoping that their stock price decreases. But what happens is what you do is essentially you borrow someone else's stock, you sell it, hoping that the price goes down so you can recapture it by the end of the trading day at a lower price. The only problem is if Tesla stock goes up in price, then you have to pay for the difference, and that could be a lot of money. So it's very, very risky. I would refrain from these types of margin or short selling. Okay, that's just a quick summary, and hopefully this makes sense.